The recent pullback in stocks isn't worrisome for some bond traders. Optimism is fueling interest in treasuries as the Fed looks to cut rates this year. For more on the bond market moves, we're joined by our very own Jared Blikre. Hey, Jared.
Hey, Brad. Investors have not liked bonds until very recently. Over the last few years, we just barely escaped what would have been an historic three-year downdraft in bonds, and that just doesn't happen. But here we can see the flows of 2023 were dominated by flows into cash. That's money markets, $1.3 trillion. And when it comes to bonds, $276 billion, and U.S. equity, $95 billion. So really, bonds actually took in quite a bit more than stocks last year. And when we think about cash on the sidelines, here's a chart that goes back before the global financial crisis over 15 years. Suffice to say, we are at record highs. So this suggests that there's a lot of money that could come pouring into the market this year. Is it going to be stocks? Is it going to be bonds? Well, or is it just going to be more cash? Hard to say, but let me get to some of the charts around the 10-year. We happen to see the 10-year T-note yield right around 4.01%. 4% is a big psychological number. And let me just show you how important it has been by showing you a chart of what happened over the last year. Last year in stocks, we were having a great year for the mega caps through July, but then as the 10-year T-note yield busted through 4%, made its way all the way up to 5% for the first time in decades, that put a real break on the equity rally. And then this downdraft of over 1 percentage point, over 100 basis points in a very short period of time, this was a tremendous tailwind, not for just the mega caps, but for all stocks. We saw a huge rush into the laggards into year end. So with the 10-year T-note yield threatening to break above 4%, it just kind of gets into the narrative. What is the Fed going to do? What are the other central banks of the world going to do? And this is the biggest thing driving flows around the world right now. And this is the interest rate structure. This is what global central banks are pricing in for their policy rate. The U.S. federal funds rate sitting above 5%, ECB above 4%, and then the Japan policy rate, that's still stuck in negative territory, negative 0.1%. So we have a Bank of Japan meeting in a couple weeks. Are they going to be raising their rate, or are the Fed and the ECB, are they going to be lowering their rate this year? All those dynamics are going to determine what happens in the global bond market, and it's going to have huge implication for flows. And then here's another interesting fact, just one more thing. Michael Hartnett over at Bank of America is saying the most important thing for the bond market this year, forget about that, it's the Treasury refinancing announcement that we get late in the month, just before month end, and that determines how much the U.S. government is going to sell in bills and bonds. That could be the big swing factor here, guys. So lots happening in the month of January.
A lot happening and a lot for investors to keep track of here over the coming weeks. All right, Jared, great stuff. Thanks.